Hi everybody, good evening. Welcome to lecture number 2, paper number 7, Direct Tax International Taxation for May 2023 and November 2023 exam. Chalo. Now before we begin our lecture number 2, let's quickly revise lecture 1. First lecture, introduction. I did some basic concepts with you. What's a previous year? What's an assessment year? And how do you compute your total income, tax liability? Total income depends on your residential status. Initially in the lecture we had discussed something about your syllabus and your paper pattern also. Thereafter we had gone to the discussion of our tax rates, and we had done the discussion of tax rates from our textbook. Individuals HUF will pay tax according to slab rate. Companies and partnership firm are going to pay tax according to a flat rate. Surcharge will be payable if you earn a super duper extra amount of income. Health and education cess is applicable for all persons, all assessees at the rate of 4%. Now relating to our tax rates, there is this one last concept that I wish to discuss with you. After that we will formally begin with our heads of income. The concept that I want to discuss with you is called as marginal relief. The concept of marginal relief finds a place in the budget. In Finance Act, in every Finance Act, the concept of marginal relief is there. Now, what exactly is this marginal relief? Some basic points to remember about marginal relief. Point number 1. This is a relief that you are getting. This is a marginal relief that you get if you are supposed to pay surcharge. So if surcharge is applicable to you, only then you are entitled to this marginal relief. There is a meaning to that word marginal also, but 2 minutes and we'll develop the meaning of that word also. This concept of marginal relief, this is available to all the assessees. It's not a concept which is restricted only to individual and HUF. Companies, partnership firms are also entitled to this concept, to this marginal relief. Now see, why do you need marginal relief? What is the need? What is the basic concept of this? Let's imagine there is one person, Mr. Albert. Let's take the example of an individual. Albert, resident of India, aged below 60 years. And this Albert has a total income of exactly 50 lakh rupees. Now does surcharge apply? Answer is no. Surcharge will apply if the total income exceeds the threshold of 50 lakhs. Individuals के लिए the threshold is 50 lakhs, partnership firm it is 1 crore, domestic company, foreign company it is 1 crore and 10 crore. In fact for individuals there are various thresholds, 50 lakhs, 1 crore, 2 crore and 5 crores. But all the assessees, the concept is that the total income should be greater than, total income should exceed that limit. So my assessee Mr. Albert is having a total income exactly of 50 lakhs. On this total income, he will pay his tax. Tax will be calculated according to slab rates of course. But as far as surcharge is concerned, surcharge will not be there because the income is exactly 50 lakh rupees. So now what is the tax that he is supposed to pay on an income of 50 lakhs? First 10 lakh rupees, he is supposed to pay a tax of 1,12,500 as per slab rates. Then anything above 10 lakhs is taxed at 30%. So from 10 lakhs to 50 lakhs, on that 40 lakh rupees, he will be paying tax at the rate of 30%. So 40 lakhs ka 30% is going to be 12 lakhs. So his tax is going to be 13,12,500. No surcharge applicable. This is going to be his tax liability. Of course, health and education cess is also payable, but currently I am not getting into health and education cess. Now, as compared to this, imagine there is one person, Mr. Sunil. This Mr. Sunil has a total income of say 50,80,000. Does it exceed the threshold of 50 lakhs? Definitely yes. Is he supposed to pay surcharge? Yes, of course. So he will have to pay tax according to slab rates. Now the tax according to slab rate is going to be very easy to calculate. On 50 lakh rupees, the tax is 13,12,500. He is earning an extra 80,000, which falls in the 30% bracket. So 80,000 ka 30% will be 24,000. So this Mr. Sunil will have to pay an additional 24,000. His tax liability, his basic tax will be 13,36,500. But now, because the income has exceeded the threshold of 50 lakh rupees, surcharge will apply, and surcharge will apply at the rate of 10%. So 1,33,650 is going to be his surcharge, and his tax currently is 14,70,150, and here lies the problem. Look at this. Mr. Albert earns exactly 50 lakhs. He is supposed to pay 13,12,500, ignoring health and education cess for the discussion right now. Lekin Mr. Sunil, he is just earning 80,000 extra. But because of that 80,000 extra, he is supposed to pay not 13,12,500, he is supposed to pay 14,70,150. So, when you analyze what is the extra tax that Mr. Sunil is paying, when you compare him with Mr. Albert, his extra tax is 14,70,150 minus 13,12,500. This is the extra amount that he is supposed to shell out to the government because his income exceeded 50 lakh rupees. His income exceeded 50 lakhs just by a small amount of 80,000. But because of that extra 80,000, his tax outflow is increasing by 1,57,650. 157,650. And why is he supposed to pay this extra tax? He is supposed to pay this extra tax because he is earning an extra income. And what is his extra income? It is that 80,000 rupees ka extra income, the income which exceeds the threshold. Now clearly, if you understand, this is unfair. This is unfair to Mr. Sunil. Mr. Sunil will say to the government, okay, I earned 80,000 extra, and because of that additional 80,000, you are asking me to pay additional 1,57,650. I don't have that much money. I don't have 1,57,650 to pay to the government because I am earning only extra 80,000. You are asking me to pay this much more. That's where the government says, yes, Mr. Sunil, you are right. We agree with you. You are being unfairly taxed. But Mr. Sunil, that is happening because of surcharge. So, Mr. Sunil, don't worry. We will give you a relief. We will call this as marginal relief. Why is the word marginal used? What was that 80,000 rupees? That 80,000 rupees is the income, or should I say that 80,000 rupees is that extra income that Mr. Sunil earned over and above 50 lakhs. Meaning, the word marginal indicates that my total income, yes, it is greater than the threshold for surcharge to apply. But the important word is that my total income, little bit, my total income, just a little bit, marginally. That's why the relief is called as marginal relief. Total income marginally exceeds the threshold. I'm sorry. Total income marginally exceeds the threshold, and that is why surcharge got attracted. But it created this type of a situation. So the government is saying, okay, Mr. Sunil, ek kaam karo. Find the difference between the two. The difference between the two, the extra tax that you are supposed to pay because surcharge became applicable, and the extra income that you earned due to which surcharge became applicable. Find the difference between the two. So Mr. Sunil will say this difference is 77,650. Mr. Sunil, This is your marginal relief. So Mr. Sunil, what amount of tax will you pay? You will pay basic tax plus surcharge, which is calculated at 10%, but wait, this is going to be reduced by the amount of relief that I am giving you. So if I just repeat the numbers, for Mr. Sunil, 13,36,500 plus surcharge of 1,33,650 minus 77,650, and this is the tax that now Mr. Sunil will have to pay. Of course, we are going to add health and education cess of 4%, but we are going to add health and education cess of 4% on this figure, the figure remaining after deducting marginal relief. Just to complete this calculation, because I want you to understand something else also, I want you to understand the numbers in a slightly better way also. Just finishing this calculation. So 14,70,150 minus, what was our amount of marginal relief? 77,650. My income tax is going to be 13,92,500, on which I am going to calculate my health and education cess. Now, the reason I wrote this, I finished this calculation, is I want a student to understand the analysis of this. If somebody understands numbers, you will in a minute understand what is this. This 13,92,500 is actually nothing but 13,12,500 and that 80,000 rupees. Sir, what do you mean? 13,12,500 is the tax that Mr. Albert used to pay. The tax that Mr. Albert used to pay. Now, Mr. Albert used to pay this tax on an income of 50 lakhs. That to anyways Mr. Sunil will have to pay, because he is earning an income of 50 lakh 80,000. So he is earning an income of 50 lakh rupees, therefore. And on that 50 lakhs, the tax is 13,12,500. And what is this 80,000? 80,000 is nothing but the extra income that you earned, due to which surcharge became applicable. If you understood this, then the doubt that comes in the mind of a student is, sir, that means 80,000 rupees is fully being paid to the government. The income that I am earning above 50 lakhs, I am fully paying that to the government. So that is 100%. That is a wrong way to think, beta. Yes, you are paying 80,000 fully to the government, but if you carefully think about these numbers, even before marginal relief, you were still paying that 80,000 rupees to the government fully. Before marginal relief, you were actually paying to the government not only that 80,000 but extra 77,650. I'll show it to you. See this. Our first example was Mr. Albert, right? Now imagine that Mr. Albert had an income of 50 lakhs and on which his tax amount was 13,12,500. So what was the income that was remaining in Mr. Albert's hands after he paid tax? He earned an income of 50 lakhs and from that 50 lakhs, 13,12,500 is what he was paying. So what remains in his pocket is 36,87,500. Fine. But now let's compare Albert's situation with Sunil. How much income is Sunil earning? Sunil is earning an income of 50,80,000 and the tax plus surcharge that we were expecting from Mr. Sunil was 14,70,150, correct? Now, if this is of course without marginal relief. So 50,80,000 minus 14,70,150. I'm sorry, 14,70,150. 36,09,850. You can see that Mr. Sunil has less income in his pocket after tax income as compared to Mr. Albert. Why? Sir, surcharge. Now, I told you na beta, I want you to understand the analysis. Now, this analysis is what I am doing. I divide this income into two parts. 50 lakhs, 80,000. And I divide this tax also into two parts. 13,12,500 and the balance 14,70,150 minus 13,12,500, which is 157,650. Now, if you correlate, you'll understand why I exactly wrote 13,12,500. 13,12,500 is the income tax on 50 lakhs. So 13,12,500 is paid out of 50 lakhs. But how do I pay that 1,57,650? I pay that out of 80,000. Which means, guys, do you observe that even before getting marginal relief, you were paying that full 80,000 rupees to the government? In fact, if you carefully think about this, you will understand that 80,000 is paid out of that extra income, and that 77,650 is paid out of the balance 36,87,500, which is the income 50 lakhs minus tax 13,12,500. If you understand these numbers now, then next 5 minutes whatever concepts I discuss with you will be very smooth for you. Mr. Sunil is earning 50 lakhs. Yes. So on that he is supposed to pay 13,12,500 just like Mr. Albert. Definitely. But because of that additional 80,000 rupees, Mr. Sunil is supposed to pay an additional 157,650. How will he pay that? Where is the money? So he'll use this 80,000 extra income and pay it to the government. That means even before getting marginal relief, he was giving away the 80,000 to the government. But that balance 77,650. Now, how does he pay that 77,650? Obviously, if you understand, he will have to pay this 77,650. 80 to gaya. 80,000 is finished. So he will have to pay it out of this 50 minus 13,12,500. Which means that Sunil is having less money with him after tax. This is because of surcharge. Now the government is saying, yes, Mr. Sunil, we agree, ek kaam karo. Don't pay this 77,650. Pay this 13,12,500 because that is the tax on an income of 50 lakhs. 80,000 you were anyways paying na. Pay that 80,000 to us. But the extra that we were asking from you, we are not going to ask that from you. That is the relief that you will get. So now the relief that I am getting is 77,650. So how much am I paying? 13,12,500. And this 80,000, which is 13,92,500. I hope the concept is a bit more clearer now. Now we will have to pay health and education cess at the rate of 4%. Health and education cess at the rate of 4% is the same for Albert also and same for Sunil also. So there is no marginal relief for health education cess. Finance Act clear cut mentions this. Marginal relief will be available for surcharge only. What is the rate of surcharge for Albert? 0%. What is the rate of surcharge for Sunil? 10%. So therefore there is relief. But Health education cess for Albert is also 4%, for Sunil is also 4%, and so there will be no relief for health education cess. There will be marginal relief only for surcharge. This is a concept which is equally applicable to companies, firms also. So what will you have to do? Find the tax on your total income. Now, in fact, putting this into a kind of a stepwise discussion, let me put it like this. So how did we understood the example, but now if I have to generalize, what is marginal relief? By 77,650. How did I get 77,650? Extra tax minus extra income. What is extra tax? Extra tax is 1470,150 minus 50 lakhs. So, sorry, minus 13,12,500. 14,70,150 minus 13,12,500. So, what will I do? Step 1, I will calculate tax plus surcharge on my total income. Step 2, I will calculate tax on my threshold limit. Now the difference between these two taxes is the extra tax. So suppose I say this is A and this is B, so my extra tax is C. Then I calculate my extra income. What is extra income? My extra income is my total income, which, by the way, just for clarity, if I write down, when I say tax plus surcharge on total income, this total income is the amount which has exceeded the threshold of surcharge. Now my extra income is total income minus the threshold, which means let's call this as D. So if my extra tax exceeds my extra income, only then I will be entitled to marginal relief. And what will be the marginal relief? C minus D. But suppose if my C is less than D, that means my extra tax is less than my extra income. What did I say? My extra tax is less than my extra income. Or in other words, I have enough extra income to pay that extra tax. So I don't need any relief, etc. My income is not marginally above, it is way above the threshold. So then in that case, my marginal relief will be 0. See this? I'll take a pretty simple comparable example. We already have one figure with us, that if the total income is 50 lakhs, the tax for an individual is 13,12,500, right? Now, suppose the total income is 60 lakhs. Is it above the threshold? Yes, 10 lakhs above the threshold. Now, what will be the tax plus surcharge on this 60 lakhs? So, see, additional 10 lakhs का income, 50 से 60, वो 10 lakhs पे 30% के हिसाब से there will be 3 lakh rupees का tax. So 13,12,500. What is this? This is the tax on 50 lakhs plus an additional 3 lakhs. This is the tax on 60 lakh rupees ka income and a 10% surcharge. So when we add the 10% surcharge, we get 17,73,750. 17,73,750. Now you can do the comparison for yourself. Tell me, what is the amount of extra income? So extra income is 10 lakhs. And what is the amount of extra tax? So extra tax is 4,61,250. Now let me just zoom out a bit. 4,61,250 is my extra tax. So this is 461,250 extra tax. This is the extra income. As I said, if you remember my dialogue, sorry, I have enough extra income to be able to pay this extra tax. Now I don't need any relief. Now even after paying this 4,61,250 from that 10 lakhs, I will still have money with me. Now there is no relief needed. So in this case, there is no relief required. I hope you understood this. That is the significance of the word marginal. The relief will be allowed only if the total income marginally, little bit exceeds the threshold limit of surcharge. Okay, and one last thing. To wrap up the concept of marginal relief, one last thing. And I am saying wrapping it up because in the book I have given you detailed examples relating to marginal relief. I'll show them to you. You can read it at your comfort. One last thing. Suppose we will continue with the example of an individual only. There is an individual whose total income is 102 lakhs. 1 crore 2 lakh rupees. I think this would be better. 1 crore 2 lakhs. Does surcharge apply? Definitely yes. On this, remember, if it's an individual, surcharge will apply at the rate of 15%. 10% becomes 15%. 10% becomes 15%. What do I mean by this statement? If I am having a total income exactly of 1 crore, then in this case, I am supposed to pay surcharge, but only at the rate of 10%. So now I will not compare, listen to what I say, I will not compare 1 crore 2 lakhs with 50 lakhs. Na. My income, if it is exactly 1 crore, I am paying surcharge at the rate of 10%. But the moment income went from 1 crore to 1 crore 2 lakhs, my 10% became 15%. So now surcharge percentage increased. Albert and Sunil ka example, Albert was 0% surcharge, Sunil was 10%. Your 10% is becoming 15%. So there will be definitely extra tax because of 10 becoming 15. And that will happen because of the extra income of 2 lakh rupees. So now work out what is the tax plus surcharge at 15%. That is 1 crore 2 lakhs wala calculation. Work out what is tax plus surcharge at the rate of 10%. That is 1 crore wala calculation. Find out how much extra are you supposed to pay because of this extra 2 lakhs. And then you apply this. Your A amount will be tax plus surcharge at 15%. That will be A amount. Your B amount will be tax plus surcharge at 10%. A minus B will be the extra tax. 2 lakh rupees will be your extra income. So if C, extra tax, is greater than 2 lakhs, you will get some marginal relief. But if C, extra tax, is less than 2 lakhs, then there will be no marginal relief available. So this concept, the reason for doing this example is to make you guys understand that even when the surcharge rate will increase because of the increase in income, even when the surcharge rate will increase, marginal relief will still be there. If the surcharge percentage goes from 15% to 25%, you will have to check for marginal relief. From 25% to 37%, you will have to check for marginal relief. In case of a domestic company, income above 10 crores, so surcharge percentage goes from 7% to 12%. Income above 1 crore, 7% ka surcharge. I am talking about a domestic company. Income above 1 crore, 7% ka surcharge. Income above 10 crores, 12% ka surcharge. So if the income marginally exceeds 10 crores, little bit, So 7 will become 12%. 7% becoming 12%. Tax will increase to a great extent. Find the marginal relief. There you will be entitled to marginal relief. So like this, marginal relief can arise even when the surcharge percentage changes. If you want, you can broadly remember this. Surcharge becoming applicable or surcharge percentage changes because of a slight marginal increase in income, so marginal relief will be available. Now in the book, see this. Towards the end of this chapter, that is chapter number 2, I have printed examples, numeric illustrations. Individuals, partnership forms, domestic company, foreign company. Everywhere in situation number 1, you will observe marginal relief is there. If you look at the 2 columns vertically, situation 1 is a situation where marginal relief is available. There is a marginal relief available. Situation 2 is that example where you are having a reasonable amount of income that you don't require any marginal relief. You will have to pay the full amount of surcharge. All these calculations are excluding health and education cess. Health and education cess is applicable at the rate of 4% in any case. So individuals above 50 lakhs but up to 1 crore, above 1 crore but up to 2 crores, above 2 crores but up to 5 crores, total income above 5 crores. For individual, all the versions of all the possibilities or all the situations of surcharge I have covered. Then comes domestic company above 1 crore up to 10 crore. Domestic company above 10 crore, partnership firm above 1 crore, partnership firm is just one surcharge concept above 1 crore, foreign companies above 1 crore, above 10 crore. So basically, one example of every assessee where marginal relief will apply, and situation 2 is where marginal relief will not apply. So whenever you get time, just go through these examples. You can cross check it with a calculator and you will understand where marginal relief is applicable, where marginal relief will be available. This will basically help you when you are solving MCQs. Sometimes especially in the institute MCQ booklet, there are some questions where marginal relief is applicable but in a hidden way. The question will tell you calculate income tax on the total income of a domestic company 10 crore 1,20,000. Now you see domestic company, you see 10 crores, you immediately realize there is surcharge applicable and you do the working. But the moment you see 10 crore 1,20,000, 10 crore 75,000, 10 crore 22,000, slight increase, the thing that should immediately click you is here maybe there is marginal relief. Let me do that working also. So this was our concept of marginal relief. Now getting into our heads of income. The first head of income that I begin with the CA final batch is capital gains. In my first lecture, I told you something about the heads of income with reference to how they appear in your exams. See, salary and house property don't come up in your papers. Salary and house property are reserved for CA Inter only. After salary and house property, next in sequence is PGBP. If you flash back to 2.5 years ago when you were studying CA Inter, the two most important, crucial, difficult topics of your CA Inter syllabus was PGBP and capital gains. At CA final also, the trend still remains. The two most difficult are capital gains and PGBP. When it comes to heads of income, by the way, heads of income, the two important ones are capital gains and PGBP, no doubt. But PGBP, the way it is tested in your question paper, you will get your compulsory question of 14 marks. The question will read compute total income, but 75% of that question will be PGBP adjustments. PGBP adjustments, PGBP case laws, PGBP section numbers, majorly from PGBP. But there will be one or two adjustments relating to capital gains, one adjustment relating to IFOS. So as a student, if you study PGBP first and then you proceed to solve questions, you must have knowledge about capital gains and IFOS and chapter 6A deductions also. And therefore, from a study perspective, what I always recommend to the students is, see, PGBP, when you solve questions, you need to know capital gains and IFRS as well. तो एक काम करो ना, might as well study them first. First study capital gains and IFRS and their connectivity with each other, and then go to PGBP. So that when you're solving questions of PGBP, you don't have to worry about whether I know this adjustment about capital gain or not. No, because you've already studied it. So capital gains and PGBP, from a CA final student's perspective, it won't make much of a difference which one do you pick up first and which one do you pick up next. But during lectures and for your study, I would always recommend do capital gains first, do IFRS next, and then do PGBP, so that when you are solving questions, institute questions, past exam questions, RTP, MTP, my question book, any other source, when you are solving PGBP questions, you are already aware about the other two heads. So you are able to solve the question fully, properly, accurately. Capital gains as a head starts from section number 45, goes on up to section 55. But if you recollect your CA Inter, you might remember that capital gains had their own tax rates also. So we will also study tax rates relating to capital gains, section 111A, section number 112, section number 112A. So basically this is the range of sections that we will be taking up, we will be focusing. Now, what is capital gains? So somebody would say, sir, capital gains mean when you sell a capital asset, what you get is capital gain. But sir, you don't sell. The word used in Income Tax Act is transfer. I am presuming that you remember this much from your CA Inter, this little bit, कि भाई when there is transfer of a capital asset, what you get is capital gains. Of course, when you transfer, you can have a profit also, you can have a loss also. The profit or loss, gain or loss on transfer of a capital asset is capital gains. This thing is what is highlighted in the charging section of capital gains. I don't know if anybody has told this to you at your CA Inter, but whenever you are studying any head of income, the correct sequence to be followed for studying the head of income is, first of all, you have to focus on the charging section. Any head of income, first you focus on the charging section. After that, you look into the computation aspects. All the sections, all the provisions created by Income Tax Act relating to computation. And then yes, there will be some heads of income which will have concepts which are not strictly computation concepts, but yes, you have to study them you have to study them in that head. This should be ideally your sequence to study any head of income. The charging section helps you to decide what the correct head of income should be. Should this income be taxed as PGBP or house property? Should this income be taxed as house property or other sources? PGBP or capital gains? Charging section will help you to decide the correct head of income. After you finish the charging section, you have decided the head of income. Okay, this income has to be taxed under this head. Now you go ahead and understand all the computation aspects. How to compute the profit, or how to compute if at all there is a loss. So loss compute karo. Computation cannot be done first. First you have to decide which head, because each head has its own computation mechanism. Now this much though it's very evident. Capital gains will arise. Capital gains will be the right head of income. Capital gains is the head of income under which you will classify this income, provided charging section 45(1) gets satisfied. And what is 45(1)? So by see, 45(1) has three aspects. Capital gain is the gain or loss arising on the transfer of a capital asset. I can divide capital gains ka charging section into these three parts, these three categories. Number one, there must be a capital asset. Number two, it must be transferred. Then whatever profit or gain I get will be as per this head of income. Now, why did I do this? Pretty simple. What's a capital asset? Capital asset, section number 2, clause number 14 defines the term capital asset. Remember clause number beta. Section 2 is a list wala section definition, if you remember the first lecture. Section number 2, clause number 47 defines the word transfer. If there is a capital asset which fits in the definition 2 clause 14, and what I have done is transfer of that capital asset, transfer as it fits up in 247, then I have a gain or a loss, and this gain or loss, this will be calculated, computed using section number 48. So actually charging section 45(1) leads us to three other sections. What you are having should be a capital asset. It must be transferred, and yes, if there is a capital asset, if there is a capital asset and there is a transfer, so by charging section 45(1) applies. Then you follow all the computation system under section 48. 45(1) also tells you one more thing. It tells you that capital gains will be deemed to be income of the previous year in which the transfer takes place. See this. This is how it is printed in the Act. Any profit or gain arising from the transfer of a capital asset. Any profit or gain, that is the first part. This profit or gain that we are talking about, this profit gain will be calculated using section number 48. Arising from the transfer. Where is this word transfer written? It is written in section 45, but where is it defined? 247. Transfer of a capital asset, where is it written? It is written in section 45, but it is defined in 214. Any profits or gains arising from the transfer of a capital asset effected in the previous year shall be chargeable to income tax under the head capital gains and shall be deemed to be income of the previous year in which the transfer took place. This is the default year of taxability. The default year of taxability is the year of transfer. If nothing is given in the question, by default it will be taxed in the year of transfer. Default previous year of taxability is the previous year of transfer. As we go ahead in the chapter, you will observe that this is the default rule, and there are exceptions also to this default rule. So when we take this chapter further, we'll see this at that point of time. Now that means to be able to decode 45(1), I must first understand capital asset ka definition, transfer ka definition, and only then I can go to capital gain or capital loss ka computation. Chalo. So first thing, definition of capital asset. Section number 2, clause number 14. Now see, last year, that is our previous year is 22-23. Last year, previous year 21-22, there was a very important amendment that came out in this definition of capital asset. Capital asset basically is of three types, is of three parts, or the definition divides capital asset into three categories. First, it says property of any kind held by the assessee. Second, it says securities which are held by foreign institutional investor. And third, something called as ULIP, unit linked insurance policy. Okay, one thing at a time. Property of any kind held by the assessee. What is the meaning here? The word property means it indicates anything and everything that has some inherent value. We do not restrict ourselves to property means like immovable property or flat and shops and godowns. No. In this definition, the word property means anything which has some bit of value, anything which does not come free of cost. It has some implied inherent value. Now that could be property of any kind. Sir, any kind means it could be movable, it could be immovable, it could be visible, tangible, it could be intangible. Does not matter. If it has some bit of value, then it is property of any kind, and therefore it's a capital asset. Now this part of the definition is so vague that practically everything under the sky is a capital asset. Anything that you can imagine as an example has inherent value. Everything, a computer, a motor car, a plot of land, shares, this shirt, this watch, mobile phone, everything has inherent value. Nothing comes free of cost. So the way it is defined, it's very loose, it's very vague, and therefore what the lawmakers, they understood this, they knew this. So what they did was they said, fine, property of any kind held by the assessee, but there are 4 exceptions that we create to this definition. Obviously, it means whatever is there in these 4 exceptions, we are into section 2. We are into the definition section. In that definition section, if you create an exception, it means these are not treated as a capital asset. Which means if they are not treated as a capital asset, obviously capital gains ka head of income does not apply. Or if I write some technical wordings, section 45(1) is not applicable. And 5 minutes ago we understood one thing, okay, by if section 45(1) is satisfied, if section 45(1) applies, only then I have to follow the computation under section 48. Now I am playing with section numbers here. What is 48? 48 is computation ka section. But computation is secondary. First I have to satisfy the charging section. For charging section it is 45, and for 45 I need to have something as a capital asset. Now whatever is mentioned in these 4 exceptions, that's not a capital asset only. So if it's not a capital asset, 45(1) is not applicable. Obviously that also means that I don't have to worry about the computation given under 48. 48 to will apply if capital gains is the head, your capital gains is not the head. So first part of the definition, property of any kind held by the assessee, but it has 4 exceptions. Now we'll keep that aside for about 2 minutes. Second part of the definition, securities held by foreign institutional investor. Remember, securities held by foreign institutional investor, these securities are always treated as a capital asset. Even to that extent that if the foreign institutional investor in its books of account classifies these securities as stock in trade, For income tax purposes, securities held by foreign institutional investor is always going to be capital asset only. This is specifically mentioned in the definition of capital asset. Okay, securities held by foreign institutional investor for tax purposes is always a capital asset. Now, why? Pretty obvious. See, who are we talking about? Foreign institutional investors. So these are investors who are abroad, who bring money into India, and we are talking about securities. So they are investing into shares, debentures, bonds of Indian companies. They are basically bringing money into the stock market. And you might remember this from CA Inter. Okay, by capital gain has its own tax rate. I spoke at the beginning also. Okay, by sorry. Okay, there are some sections where capital gains is taxed at a different rate, at a different tax rate. Foreign institutional investors will generally have a high tax rate. They are foreign investors. They would fall in the category of foreign companies, 40%. But no, if we consider it as a capital asset, always capital gains ka head will apply. And the moment you apply capital gains ka head, it means we are allowing them, we are giving them the benefit of the capital gain wala tax rates, which is obviously lower than 40%. So our intention is to ensure that these foreign investors invest money into India, continue to invest money into India in securities, and so we are saying it's always a capital asset. Now the third part, unit linked insurance policy. What is this? Last year, 2021's budget brought about this change. Any unit linked insurance policy which is issued on or after 1st of February 2021. 1st February 2021. This unit linked insurance policy which is issued on or after 1st Feb 2021 and the yearly premium exceeds 2,50,000, then this unit linked insurance policy is a capital asset as per the definition. Now see, we are going to devote about 1.5 hours specifically for unit linked insurance policy ka discussion. So right now I'm just giving you a trailer. A unit linked insurance policy, so it's an insurance policy na? It's a life insurance policy. The difference is that you don't have a sum assured. Here the insurance value is connected to the value of units. Like a mutual fund is issuing units to you, this insurance company will issue units for the premium that you pay. You paid the premium, they gave you units. Now the units are on the stock exchange. They are there at the stock market. So their value, unit ka value will keep on changing and you will get your insurance money according to units ka value. Now what is the government thinking? Government is saying ke dekho, it's an insurance policy and we all know that for life insurance policies exemption is available. Section 1010D. Amount received from a life insurance policy is exempt under section 10 clause number 10D, including the bonus that you get. So traditionally life insurance policies have been given exemption. But if you are buying a ULIP and the premium that you are paying is greater than 2,50,000, government is saying your motive is not insurance now. Your motive is basically investment. This is an investment product which is being designed, which is being shown as a ULIP. So now we are not going to give you the benefit of exemption that we give to insurance policies. ये तो investment है, because you are paying 3 lakhs, 3,20,000, 4 lakh, 5 lakh, 10 lakhs का premium. So you are basically investing into these so-called policies. So ये insurance नहीं है, this is investment, and so we are going to tax it. Section number 1010D का exemption will not be allowed for these type of ULIPs. Any ULIP which is issued on or after 1st of February 2021. 1st February 2021, by the way, if you understand the significance, 1st Feb 21 is Finance Act 21, the day it was announced. February में announce होता है ना, तो Finance Act 21 was announced. ये last year का exemption, last year का amendment है. So 1st Feb 2021, the budget introduced this concept. As of now, I'll speak only this much. There are 2-3 other things that we have to study about this. A doubt that could be arising in your mind is, okay sir, yearly premium is greater than 2,50,000, so this ULIP is included in the definition of capital asset, na? So what if the yearly premium is below 2,50,000? Doubt number 1. Doubt number 2, sir, what if we go to 3-4 insurance companies and purchase 3-4 ULIPs, one from each company, the total premium goes about 2,50,000. The lawmakers have taken care of each and every situation. As of now, I am just giving you a trailer, as I said, okay, by definition of capital asset includes this type of ULIP also. Another doubt that can arise in your mind is, sir, this is a policy which is issued after, on or after 1st Feb 2021. So sir, what about the old policies, old ULIPs, which were already purchased by the assessee in 2020, for example, or 2019, for example? What happens to them? So we'll address all of these things when we specifically do this ULIP wala thing. It is too early at this stage of the chapter to discuss this aspect with you. So basically my focus right now is to explain to you the definition of capital asset. By this, the definition of capital asset. Basic definition: property of any kind. Securities held by a foreign institutional investor, always a capital asset. And ULIP issued on or after 1st Feb 2021, where the yearly premium exceeds 2,50,000, is a capital asset. Now if you fit in the definition of capital asset, so charging section 45 will apply to you. Acha. Now the definition is actually not complete. See, second part of the definition, securities, there is nothing to study. Third part of the definition, I told you we will be studying in depth, but later on. So now where we have to focus is on that first part. Second and third we are going to study later on. First part, this part is where we need to focus right now. Property of any kind held by the assessee. Okay. 4 exceptions. Now let's focus on these 4 exceptions. Something pretty simple. What are these 4 exceptions? I won't spend much time on it, primarily because I feel that in your CA Inter you have studied this in detail. What are my 4 exceptions? First, if there is any stock in trade, if there is any raw material, if there are any consumables. Now stock in trade, raw material, consumables, the moment you start using these words, the head of income that comes to your mind is PGBP. So when stock in trade is sold, raw materials are sold, the income will be taxable under PGBP. Under PGBP ka charging section 28. Then should section 45 apply to stock in trade? Should not. Income is to be taxed under PGBP ka head, na, not under capital gains. So we said, okay, stock in trade, raw material, consumable are not capital assets only. Remember that this stock in trade does not include the FII wala securities. Securities which are held by FII are not covered by this exception. This exception only applies to the first part of the definition, property of any kind. It does not apply to securities held by FII. FII, even if they hold securities, stock in trade or investment, for tax purposes, it's always a capital asset. Stock, raw material, consumables to be taxed under the head PGBP, so not to be taxed under capital gains. Okay. Second exception. Second exception is what is called as personal effects of the assessee. Now what is the meaning of personal effects? 2 important words to pay attention to. First, personal effect means it is movable property which is held for personal use. Personal use of the assessee or his family member. So, I said na, two important words to pay attention to. One, it should be movable, it should be movable in nature. Second, it should be held for personal use. Meaning, anything which is movable in nature held for personal use. This shirt, movable property held for personal use. But if I sell this shirt and assume karo that somebody buys the shirt also and assume karo that I earn some profit also. But that is not this shirt is not a capital asset because it is movable held for personal use. My mobile phone, movable held for personal use, not a capital asset. Sir, not a capital asset, which means there will be no capital gains. But sir, the profit will be taxable, na? IFOS mein? No. Understand one thing. See, when you are talking about these four exceptions, you know that capital gain as a head of income does not apply. So, if any other revenue head of income applies, like exception number 1, PGBP, so you take the income and put it under that relevant head. You are selling stock in trade. It is taxed as PGBP, tax it under that head. But you are selling personal effects. Now, when you are selling personal effects, it is not taxed under capital gain. That is for sure. This is not salary income. This is not rent income which you would put in house property. This is not business activity. You are selling something personal in nature and it's not capital gains. So, you might try to put it under IFOS. No. You cannot put it under IFOS. You cannot put it under any other head of income. Sir, why? The answer is on the screen. If it is held for personal use, now we all know relating to this personal wala concept, कि भाई when an expenditure is personal in nature, so that personal expenditure is disallowed, is not allowed as a deduction, which means when expenditure is not allowed, so the income will not be taxable also. Now, again, I kind of spoke something which is not just specifically related to capital gains, but it is kind of general in nature. When I purchased my personal mobile phone, I was never given a deduction of that expense. So now when I earn income by selling that personal mobile phone, it's not going to be taxable also. Not under this head, but under any head of income, it's not going to be taxed. If I incurred an expense for personal purposes, then that expense was not allowed to income profit by selling that thing will not be taxable. Personal effects is movable property held for personal use. Okay, so somebody might analyze this definition like this also. Okay, sir, if the property is movable plus held for personal use, then is it a capital asset? Answer is no. So sir, that means that if a property is movable but it is held for business use. Sir, example, I am not talking about stock in trade. Nana, stock in trade has already been covered by the first exception. I am talking about a movable property, fixed asset type of a thing, which is held for business use. Then definitely yes, it is treated as a capital asset. Beta yaad karo, In the chapter of PGBP, we've studied depreciation, section 32. Depreciation is an expense for you and it is calculated using block of asset concept. Try and recollect the blocks. What are the blocks? Building, machinery, plant, furniture, intangible asset. Now, furniture, movable, machinery, movable, plant, movable. They are movable, but they are held for business use. Now, if you recollect your CA Inter, when you would sell the entire block, you did not calculate depreciation, you calculated capital gains. When you sell the entire block, you calculated capital gains. Why did you calculate capital gains? Because what you did was sale, which is a type of transfer, and block of asset is a capital asset. Block of asset, property of any kind? Yes, block of asset is property of any kind having inherent value, but movable? Yes, furniture, machinery is movable, but held for business use, not held for personal use. That means the block does not fall in the exception. The block does not fall in the exception. It falls in the main definition, all right, but it does not fall in the exception. That means it is a capital asset, movable but held for business use. Sir, what if something is held for business use but it is immovable in nature? Factory building, office building, held for business purposes, immovable in nature. Obviously, definitely yes, it is a capital asset, no doubts about it. And if something is immovable and held for personal use, sir, this is personal effects? No. Personal effects means movable property held for personal use. The place where we stay, our residential flat, that is definitely for personal use, but it is immovable in nature. Immovable hai. That means, is it included in the definition of capital asset? Definitely yes, it is included in the definition of capital asset. Capital asset का definition says personal effects are not a capital asset. So if you have something immovable, whether held for business use or personal use, it is always a capital asset. If you have something movable and that movable thing is held for personal use, only then it is a personal effect. Only then it is an exception to the definition of capital asset. Okay. Now, this much seems to be clear. Here, the government has put up a small twist. Government says, okay, basic definition, personal effects, movable property held for personal use. But it says, by something like jewelry, drawings, paintings, any work of art, any archaeological collection, sculptures, all these, although they are movable, although they are held for personal use, they are not considered as personal effects. Capital asset does not include personal effects, but personal effects does not include these items, which implies that means all these items are treated as a capital asset under section 2 clause 14. Jewelry has ornamental value. It's made out of gold, silver, diamond, ruby, stones, platinum. jewelry ka value will appreciate over time. It's very much possible that I have purchased jewelry 10 years ago for 60,000 and today I'm able to sell it for 6 lakh rupees. That's because of the ornamental value involved in it. That's because of the gold, diamond, etc. in it. Drawings, paintings, work of art, artistic value, archaeological collections, antique value. These are movable definitely. Held for personal use definitely. But they will generate super duper profits when sold. And now government wants to tax that profit. If government has to tax the profit, government has to satisfy charging section 45, which says it must be a transfer. Okay, sale is included in transfer and it must be a capital asset. Now in the definition of capital asset, we have just said that by personal effects are not a capital asset, and all these items specifically are movable and held for personal use. Therefore, I need to ensure that these items, if I want to tax all these items, if I want to tax them, I have to make these items a capital asset. So I say, okay, although these are movable and held for personal use, they are not personal effects. They are not personal effects, which means they are treated as a capital asset. Section 2 clause 14 will apply to them. These items will be considered as a capital asset. Chalo, going ahead, we are doing 4 exceptions to the definition. Exception number 3. Yeah, exception number 3, reasonably simple. Sometimes the institute asks this in the form of an MCQ. So please understand this carefully. Exception number 3, in the act it has been drafted in a very complex way, very complex way. So when you decode all of that, you come to this conclusion: rural agricultural land in India is an exception to the definition of capital asset. So if I sell rural agricultural land in India, capital gains is not taxable. Chalo, first some basic things that I will clarify. Capital gains is not taxable. Can you put this under any other head of income? So ask yourself, when you sell rural agricultural land in India, do you earn salary income? No. Are you earning rental income? No. This is sale wala situation, not rent. Is this PGBP? Is this held as stock in trade for you? No. Can you put it in IFOS? No. Sir, why no? Why not IFOS? Observe the 4 heads of income that I just named: salary, house property, PGBP, IFOS. Those 4 heads of income are all revenue in nature. When you are earning profit by selling rural agricultural land, what type of income are you earning? Revenue or capital? Obviously capital. For capital type of income, you have a head. Which head? Capital gains. The other 4 heads of income are anyways revenue. So this income, if at all it is possible to tax, it can be taxed under capital gains. But this is an exception to the definition of capital asset. So capital gains is not applicable. And by if capital gain is not applicable, the other 4 heads of income are anyways revenue in nature. So other 4 heads will also not apply. Sir, are you trying to tell us that the profit is fully exempt? Yes, I am telling you that the profit is completely exempt from tax, completely tax free. Rural agricultural land ka sale is going to give you profits, but there is no mechanism to tax it. The only head of income that is possible at all, if it is possible, is this head of income, capital gains. But we have excluded this from the definition of capital asset. So it is not going to be treated as income under any head. This is the first basic thing to discuss. Now look at how I have written this thing. What is the asset that I am talking about? The asset that I am talking about is land. Where is the land? In India. Where in India? In a rural area. And what are you doing with the land? Agriculture. Sorry. This is what I want a student to understand. What is this third point? It's an exception to the definition of capital asset. Keep this at the back of your mind, okay? Now, if the plot of land is in India, second possibility, plot of land is outside India. Chalo, if the plot of land is outside India, so the story is over. Does it fall in the exception? This exception that we are talking about? No. Which means if the plot of land is outside India, it is a capital asset for sure. If the plot of land is in India, then where is it? So option 1, it is an urban area. Option 2, it is in rural area. If the plot of land is in urban area, then also story gets over. By if the plot of land is in urban area, it is a capital asset. The exception is talking about rural, na? This is in urban area. Acha. If the land is in rural area, then further two possibilities, that the land is used for agricultural purposes, agricultural activities, or the land is used for non-agricultural commercial activities. So if it is non-agricultural, again it becomes very simple that yes, it is a capital asset. Only if it is a rural agricultural land situated in India, then it is not a capital asset. So now when you analyze this chart, you have one doubt. Sir, in India, outside India, we easily understand. Okay, nobody needs to explain where the land is. In India, outside India, there is nothing to explain. Sir, second, used for agriculture purposes, used for non-agriculture purposes, that's also easy to understand. If you are using the activity for, if you are using the plot of land for cultivation activity, farming activity, it is agriculture use. If you are using it for non-agricultural business purposes, industrial purposes, non-agriculture. Sir, but what we are confused about is, how do we understand which area is urban and which area is rural? Like, these are two English terms, but they are very vague terms. Rural means you can't say village. Urban does not mean you can't say city. No. And Income Tax Act also understands this. So Income Tax Act has clear-cut defined what's a urban area, what's a rural area. It has not left it to any scope for confusion or interpretation. It has defined it. I told you na, if the way it is printed in the Income Tax Act, if you start reading it that way, you'll get confused to a great extent. The confusion is this definition, urban area, rural area. Okay, observe this. Use your common sense now. Now, purely common sense. Dekho. If there is a city, a town, a place where the population is greater than 10,000. So more than 10,000 people are staying. 50, 60, 90,000, 1 crore, 10 lakhs, 25 lakhs, 10 crores, more than 10,000. If the place, city, town, village, but the section has used the word town, so I'll stick to the word town. If the town has a population of greater than 10,000, then this town, this place is covered as urban area. Okay. That means if there is a town where the population is less than or equal to 10,000, sorry, I'll make one change beta. 10,000 or more, less than 10,000. So now if it is less than 10,000, this is rural area. 500 people staying, 7,000 people staying, 3,000 people staying, rural area. This is the first part of the definition. Okay. Second part of the definition. This much is kind of pretty easy to understand. Second part of the definition. Now we are talking about a place, a town where the population exceeds 10,000 but does not exceed 1 lakh. Obviously this town is an urban area, but from the limits of this town, from the ending of this town, from the limits of this town, I think it is better if I don't use this, up to a distance of 2 kilometers is also considered as urban area. So the town is definitely urban area, but once the local limits of the town end, up to 2 kilometers measured aerially, measured like how a bird flies, aerially, not via roads, directly, straight, up to 2 kilometers is urban area, and beyond 2 kilometers is rural area. If there is a town where the population of this place exceeds 1 lakh but does not exceed 10 lakh. So, but obviously this place is urban area, but from the limits of this place, a distance of 6 kilometers is treated as urban area, and beyond 6 kilometers is treated as rural area. And the last part of the definition says that if there is a place where the population, now you can easily guess what I am going to write down, that the population exceeds 10 lakhs. So quite naturally, the population exceeds 10 lakhs, it is for sure urban area, and from the limits of this place up to 8 kilometers is treated as urban area, beyond it is treated as rural area. Now this is the definition of rural area and urban area. Remember, that's not just sufficient to decide whether or not it's a capital asset, you also have to consider it to be an agricultural land. But if I tell you that I have this land number 1 in this place, so it is a capital asset. If I tell you I have land number 2, which is an agricultural land in India, but in this town where the population is below 10,000, rural area, agricultural land, not a capital asset. If I have land number 3 here, land number 4 here, land number 5 here, then 5 is not a capital asset, 3 and 4 are. If I have land number 6, land number 7 here, but land number 8 is here, so land number 8 falls beyond 6 kilometers, so it is located in a rural area. If it is agriculture in nature, it is not a capital asset. Land number 9, land number 10, definitely capital asset, but land number 11 beyond 8 kilometers are not a capital asset. So land number 2, 5, 8, 11, let me clarify, agricultural land number 2, 5, 8 and 11 are not a capital asset. This is my third exception. Rural agricultural land located in India is not treated as a capital asset. Chalo, finishing it, fourth and the last exception. We are doing the definition of capital asset. Fourth exception, called as gold deposit certificates. There was something started by this government in the year 2015. The Modi government started something called as Gold Monetization Scheme 2015. According to this scheme, gold deposit certificates are issued. What is this whole scheme about? So see, for Indians, gold is a place of investment. We don't treat gold as a commodity. We treat it as a place where we can invest and earn profit out of it. Now, we have a lot of gold in the form of jewelry, in the form of bullion, raw gold. Government of India came out with this gold deposit certificate, where what does an assessee have to do? An assessee will surrender his gold, he will surrender his jewelry to the central government. Central government gave out this job to banks. Bank would accept your gold. If you give jewelry, they would melt the jewelry and find out how much pure gold is there in that jewelry, and central government will give it to you in writing, issue a gold deposit certificate to you. Then on this gold deposit certificate, every year you would get interest, very nominal interest, 1.5%, very nominal rate of interest, or 2%. And as far as taxability is concerned, this interest would be exempt from tax, section 1015. By the way, that is a very irrelevant thing in the context of what we are doing, so do not focus on that exemption right now. At the end, what would happen is, central government on redemption, if you held this gold deposit certificate up to the end, on redemption you would get money at the prevailing gold rate. And if you carefully think about this, so this gold deposit certificate is not a capital asset only. That means at the time of redemption, whatever profit you earned, this profit is not taxable at all. You purchased jewelry, you purchased gold at the rate of say 30,000. So this 30,000 was your cost. You surrendered it. You got gold deposit certificate in return. And when redemption happened, gold prices, for example, had gone to 65,000. So 30 minus 65 का जो profit है आपका, that profit is not taxable at all, because gold deposit certificate is not a capital asset only. By chance, if you sold the gold deposit certificate, sold it, you did not keep it right up to the end, you sold the gold deposit certificate for say 46,000. Now 16,000 ka profit, but that profit is also not taxable for you, because not a gold deposit, but because it is not a capital asset only. Why is the government doing this? Because the advantage is that government will take all this gold from you, and foreign countries में gold will be kept as mortgage, and if that happens, foreign countries will give the central government loans at much cheaper rate of interests, which the central government will use for our Indian economy. If you don't give gold as mortgage, the rate of interest increases slightly. By giving gold as mortgage, interest rate on that loan slightly reduces. So how does the government get the gold? It goes to the general public and it tells the public, surrender your gold we will give you gold deposit certificate, and the profit that you will earn is completely exempt from income tax, completely exempted from income tax. So it's not a capital asset because it is included as an exception. So as an assessee, if you compare in your mind, gold purchased, gold sold, profit is taxable. Jewelry purchased, jewelry sold, profit is taxable. Gold deposit certificate is what we get, and then we earn profit on that. Profit is exempt. This is the government's way of giving you kind of an incentive so that you surrender your gold, you surrender your jewelry, you will get tax benefit in the form of exemption, and government will take that gold, mortgage it, get loans at cheaper rate of interest and use that loan for the country. Chalo. So finishing the definition of capital asset. Capital asset ka definition has three parts. Property of any kind held by the assessee, securities held by foreign institutional investor, always a capital asset, and ULIP, unit linked insurance policy, issued on or after 1st Feb 2021, yearly premium exceeds 2,50,000. Detailed discussion about ULIP pending. Securities held by FII, always a capital asset. Property of any kind held by the assessee, 4 exceptions to it. Raw material, stock in trade, taxed under PGBP. Personal effects, which is movable property held for personal use, but personal effect does not include jewelry, drawings, paintings, work of art, sculptures, archaeological collection, etc. Third, rural agricultural land located in India, and fourth, gold deposit certificates. These 4 are not treated as a capital asset. Otherwise, anything which is property of any kind, inherent value, movable, immovable, tangible, intangible, will be considered as a capital asset. Now, after you finish learning the definition of capital asset, well, you need to know one more thing. A capital asset is of 2 types. Even this is something that you have studied from your CA Inter. You have a capital asset which is either called as short-term capital asset or a capital asset which is a long-term capital asset. Why do you need to divide a capital asset into 2 categories or 2 parts, short-term or long-term? Why do you need this distinction? For 2 reasons. 1. Whether the asset is short-term or long-term will help you to decide your formula for computation. We saw that computation is as per section number 48. 48 tells you that there are 2 formulas available, or there are 2 ways in which you will calculate capital gains. That depends on the type of your capital asset, short term or long term. Second, the rate of tax. Tax rates for short term capital gain are different, and tax rates for long term capital gain are different. So step 1 in any capital gain situation is to determine whether the capital asset is short term or long term. How do you decide whether the capital asset is short term or long term? That depends on the concept called as holding period. For how long have I held the capital asset? For how long was I holding the capital asset? If that is small, short term; if that is more, long term. Now, of course, less, more, that's very vague. So, this has been specifically defined in section 2. Section 2 has defined what is a long-term capital asset, what is a short-term capital asset. See this. Long-term capital asset, section 2, clause number 29A. Short-term capital asset, section 2, clause number 42A. If you read the definition of long-term capital asset, long-term capital asset means a capital asset which is not a short-term asset. That means, first of all, we have to study what is a short-term capital asset. Short-term capital asset means a capital asset held by the assessee for not more than 36 months immediately preceding the date of transfer. Not more than 36. So it can be either 36 exact or less than 36, but never more than. This is the basic definition. Then there is a paragraph starting with the word provided. In my first lecture I told you that any paragraph which starts with the word provided means we are talking about a proviso. And what is the meaning of a proviso? It's an exception. Provided that if you are talking about a security other than a unit, units are not covered. A security which is listed on a recognized stock exchange in India, or a unit of Unit Trust of India, or a unit of a equity oriented fund, or a zero coupon bond. The provisions of this clause means clause number 42A of this section number 2 shall have effect as if for the words 36 months, the words 12 months had been substituted. So, less than or equal to 12 months would be short term for a security which is listed, but listed where? On a recognized stock exchange in India, unit of Unit Trust of India, unit of a equity oriented mutual fund, not every mutual fund, it should be an equity oriented mutual fund, and a zero coupon bond. So the holding period has to be less than equal to 12 months. And then the next proviso, provided also that if I am talking about a share of a company not being a share listed in a recognized stock exchange in India, share which is listed in a recognized stock exchange in India will obviously get covered in this first proviso. First proviso is talking about the word security. Security will include shares also, will include bonds also, will include debentures also. Security is a very wide term, but listed securities are covered in the first proviso, that means in the 12 months criteria. So now in my second proviso, please take care, I am only talking about shares. I am only talking about shares, I am not talking about all securities. Now, if you are talking about a share of a company which is not listed in India, or if I am talking about an immovable property which is land or building or both, then the provisions of this clause will have effect as if for the words 36 months, 24 months had been substituted. So if I am talking about a share but the company is not listed in a recognized stock exchange in India, so that means first example that will pop up in your mind is कि भाई I am talking about shares of a private limited company which is not listed in India. Second example that can come up into your mind is share of a public limited company, but a public limited company which is an unlisted public limited company. It's a public limited company but not listed in stock exchange. Third, if you understand, I can also cover shares of a foreign company here. Share of a foreign company, is it listed in a recognized stock exchange in India? No. Example, shares of Microsoft, shares of Tesla, shares of BMW, shares of let's say Walmart, they are all listed outside India, so they don't fall in the 12 months criteria. They will fall in the 24 months criteria because they are share of a company. Foreign company is a company but not listed in India, could be listed elsewhere, we are not concerned. Then 24 months will apply. So see this. This is the analysis and the table which analyzes the whole definition. Where will 12 months apply? Where will 24 months apply? Where will 36 months apply? Of course, all of this has to be a capital asset. So when I say land, obviously I am not talking about rural agricultural land in India. Rural agricultural land in India is not a capital asset only, so we are not bothered about this. It has to be a capital asset for sure. 12 months, 24 months, 36 months. This is how you divide it into short term or long term. Okay. Coming back, see this. I took 45(1) as the base and I started this chapter. 45(1) gets divided into 3 installments: capital asset का definition, transfer का definition, and computation under section 48. Of the 3, that computation under section 48 is the lengthiest, is the more important, more difficult one. So I'll do this third thing, computation under 48, a bit later. First part, definition of capital asset, we've already finished. In addition to that 214, we also saw section 242A and section 229A, short term, long term. So I might as well, I'll write down that also here. Short term, long term is also included in the concept of capital asset only. Now let's focus on the definition of transfer. Honestly, not much to discuss here. Definition of transfer. I'll go through it, but if you remember your CA intermediate, so there is nothing great here. We'll not waste much of time here when it comes to definition of transfer. See, transfer in relation to capital asset includes, number 1, sale. The most obvious example of transfer is sale, where in case of sale, what you get is money. As a seller, your consideration is monetary. Exchange, so which means you are giving up a capital asset, but you are getting something in kind as your consideration, non-monetary consideration. But definitely that means you are giving up your capital asset, and instead of getting a check, say for example a check of 2 crores, you are getting an asset worth 2 crores, but you have given up your asset, so that is included in the definition of transfer. The only thing that I would make a student observe, which is also very simple actually, this is the word which is used in section 45(1), charging section. That means exchange is a type of transfer, and transfer is the event where charging section will be triggered. That means you will have to pay tax on capital gains, not only when you sell but also when you exchange. Relinquishment of the asset. Dictionary meaning of the word relinquishment means you surrender the asset, you give up the asset. The most simple examples: buyback of shares, redemption of preference shares, redemption of debentures. You are surrendering the asset back to the person who gave the asset to you. The company issued the shares or debentures, you are giving it back to them. Sale would be sale to a third party. Exchange will be with a third party. Relinquishing is giving it back to that person who gave the capital asset to you in the first place, and you are surrendering it and you are getting your consideration. Extinguishment of any rights therein. Extinguishment of any rights therein. Rights therein means rights where? Rights in the capital asset. So, say you and your brother and your sister, you are the joint owners of a property, and you give up the right, give up your right in that flat, in that property in favor of your sister. So in the capital asset, what was the capital asset? The flat. In that you had a right, that's also a capital asset, and you are surrendering it, you are giving it up. That's why you may observe that practically relinquishment and extinguishment are used interchangeably. When you surrender the capital asset only, it is relinquishment. When you surrender your right in that capital asset, it is extinguishment of the right. But quite frankly, whether you call it as extinguishment or relinquishment, everything is transfer. So capital gains will be taxable in every case. Compulsory acquisition under any law. Compulsory acquisition will be done by the government. Sorry. And what you will be getting is not called as consideration. What you will be getting is called as compensation. Government is compensating you for taking away the land, for taking away your capital asset. Sale, first point, the two parties are willing to do the transaction. Compulsory acquisition, I am not willing to give it to the government, but the party on the other hand is government. It is compulsory as per law. Only government can do it, by the way. I mean, one individual cannot compulsorily acquire your capital asset. No. This is the power given to the government only as per law. So government is wanting to acquire it, and because this government is compulsory for you, but they will not just take away the asset from you, they will give you compensation. That compensation is the consideration that you are getting for giving up your asset. Point 4. In a case where the asset is converted by the owner or is treated by him as stock in trade of the business carried on by him, then such conversion or such treatment is considered as a transfer. You might remember this from your CA Inter, that when a capital asset is converted into stock in trade, then this event of conversion is considered as a transfer, and then when eventually this stock in trade will be sold, so you will get your cash inflow. You will sell the stock. That sale of stock will give you your business income, and conversion of capital asset into stock in trade will give you your capital gains income. So this conversion is regarded as a transfer. Maybe 1 or 2 lectures down the line, we will see how to find the taxable amount. As of now, I am just restricting my discussion to the definition of transfer. Ki, haan bhai, this is also a transfer. I have kept the asset with me only, but earlier I used to show it as a capital asset. In my balance sheet, I used to show it as a fixed asset, as an investment. And now, in my balance sheet, if you understand the balance sheet perspective, it was earlier shown as a fixed asset, or it was earlier shown as investment, and now it has been converted into stock in trade. So it is still with me only, but now it is no longer a capital asset, now it is stock in trade. This event is also considered as a transfer, and capital gains will be subject to tax. Then maturity or redemption of a zero coupon bond. Just to give you a small hint about this, we are going to do this in PGBP anyway. Interest is at 0%. Even this is CA intermediate knowledge. I am pretty hopeful that you will remember this. But these zero coupon bonds, they are issued at a discount and they are redeemed at par. So let's say, for example, on redemption you are getting 100, but they are issued for 40. Now 40 is your cost and 100 is what you are getting at the time of redemption. So 60 is your capital gains, and you are not getting any interest during the lifetime of the bond. Zero coupon bonds are issued by infrastructure capital companies, infrastructure capital funds, public sector companies. The objective is to raise money for infra development, and so you will not get any interest during the lifetime of the bond, but you invest X rupees, and which will be a discounted value. Sorry, that will be a wrong word. You will invest a certain amount which is a discounted price, a discounted value as compared to the face value, and at the end you will get back the face value. So you will earn income. The difference is you will not earn interest income, you will earn capital gains. So the event of maturity or redemption is also covered as the definition of transfer. Any transaction involving the allowing of possession of any immovable property to be taken or retained in part performance of a contract as per 53A of Transfer of Property Act. What are you doing? You are allowing the possession of the immovable property. Why? Because there is part performance of the contract. Who did that part performance? This part performance was done by the buyer. So this was allowed by the seller, and 53A of Transfer of Property Act calls this as a transfer. So some part of the contract is performed, balance part of the contract will be performed in due course. The buyer has paid a certain percentage of the consideration, balance consideration he will pay later on. He has agreed he will pay it. On that agreement on that promise. You are allowing him the possession of the property, and everything is as per contract. There is nothing oral. There is a contract in writing. There is a contract in writing for a consideration. As a seller, you are allowing the possession because he has partly performed the contract and agreed that he will perform the balance part also. So you have executed the transaction. It is considered as a transfer. And the last one, any transaction which has the effect of transferring or enabling the enjoyment of any immovable property. When you become a member in a cooperative society, in a company or any other AOP, because you are acquiring shares. So when you purchase a flat or a shop in a society, you also get shares along with it. So you become a member. Now you become a member because you purchased it. Now the one who sold it, for him it is regarded as a transfer. So this is your definition of transfer. There is an explanation. We will keep this pending because one lecture later there will come a situation where I will cover this explanation in depth, very famously Vodafone case law. So at an appropriate stage I will bring this Vodafone case law into our discussion. As of now I am keeping this explanation pending. There is also an explanation in the definition of capital asset that we just finished. I have kept that also pending. Those two explanations, one in the definition of capital asset, other in the definition of transfer, I am deliberately keeping that pending. When the opportunity comes, we will discuss the Vodafone case law and we will discuss the Vodafone case and we will see how those two explanations are important. So coming back, definition of transfer also discussed. Now comes our computation, gain or loss. Now I told you that section 48 is lengthy, is important. Let me show you section 48 the way it is printed in the act, and that will give you a hint as to why did I say that it is important. See this. The income chargeable under the head capital gains shall be computed by deducting from the full value of consideration received or accruing as a result of transfer of the capital asset the following amounts. Clause 1, clause 2, clause 3. What is clause 1? Expenditure incurred wholly and exclusively in connection with such transfer. You are incurring some expense which is fully, exclusively, only in connection with transfer. Let's call this in simple wordings transfer expenses. Example, you are paying commission, you are paying brokerage to the broker who arranged the deal. You are appointing a lawyer who will draft the contract. You will take legal advice from him as to how the transaction should be executed. You will pay him his legal fees, legal charges. That is an expenditure incurred in connection with transfer. The transferor is incurring it. Clause number 2. Cost of acquisition and cost of any improvement. Cost of acquiring the capital asset and cost of improving it, making any improvement in it. Please observe, the word is not purchase, the word is acquisition. So the word purchase, yes, obviously will be covered in this definition, purchasing the capital asset. If you don't purchase it but you get the capital asset constructed from scratch, you are constructing the capital asset, that is also acquiring the asset. You can acquire it through will, you can acquire it by way of gift, you can acquire it by various modes. You can acquire it, you are not purchasing it but you are getting it. Cost of acquisition and cost of any improvement. So improvement meaning you are making any changes, you are making any addition to the capital asset. Of course, when I write the word cost, in this chapter I don't mean revenue expenses. In this chapter obviously I mean capital expense only. The chapter is capital gains, so capital type of expenses are covered. Clause number 3. In case of value of any money or capital asset received by a specified person from a specified entity as referred to in subsection 4 of section 45. The amount chargeable to income tax as income of such specified entity under that subsection which is attributable to the capital asset being transferred by the specified entity calculated in the prescribed manner. Sir, what is this? We never saw this in CA Inter. Yes. CA Inter syllabus, this point is not there. This point is inserted by Finance Act 2021, last year's budget, only to be studied at CA final. Actually speaking, super important. But if you observe one thing, yes, it did not make any sense right now. But if you observe one thing, there is a mention, there is a reference of section 45 subsection 5. So, as of now, all that I will write down is section 45 subsection 4, whatever is the amount taxable under that section is attributable. This is attributed, section number 48, clause number 3. So, once we do 45 subsection 4, we'll be easily able to understand 48 clause number 3 also. Now, my point, I'm not focused on clause number 3 right now. I want you to understand something. Look at this section 48. The income chargeable under capital gains. From the full value of consideration, you will deduct number 1, transfer expenses, number 2, cost of acquisition, cost of improvement. Clause number 3 I am ignoring right now. But you remember this in your CA Inter you have studied. Sir, in case of long term, sir, we were told that we have to subtract index cost of acquisition, index cost of improvement. Answer is correct. But this is the section right in front of you where there is absolutely no mention about indexation. So, do you have to do indexation? Do you have to do indexation or you don't have to do indexation? In section 48, nothing is written. Actually, it is written. See, what I am now about to speak is not taught to CA Inter students in this way. It is simplified and put it in front of CA Inter students. CA final students, you are mature enough to understand this. Read the very first line. The income chargeable under the head capital gains. The income. Does it say short term or long term? No. It only says amount chargeable under capital gains. But we know that under capital gains, there is short term also and there is long term also. So, this formula is a general formula given. After writing this entire formula, what the Income Tax Act did was, it created provisos. There are 7 provisos created in section 48. And in the second proviso, indexation is covered. So there is a main formula in section 48 which gives you, section 48 ka initial part gives you the main computation method. Then the second exception, second proviso. If we are talking about long-term capital gain arising from the transfer of a long-term capital asset, other than capital gains arising to a non-resident from the transfer of shares in or debentures of a Indian company referred to in the first proviso. Wordings kya hai? Other than. Other than. So, what about the first proviso? Let's discuss this a bit later. But yes, one thing is for sure. Okay, if we are not talking about the first proviso situation, other than the first proviso. Other than the first proviso, where long-term capital gain arises from the transfer of a long-term capital asset, the provisions of clause number 2 of section 48. Remember, only clause number 2 is what I am talking about. I am not talking about clause 1 and I am not talking about clause number 3. I am only talking about clause 1 and I am only talking about clause 2. The provisions of clause 2 will apply. Now guys, what is clause 2? As if for the words cost of acquisition, index cost of acquisition, as if for the words cost of improvement, index cost of improvement respectively had been substituted. See this. What did section 48, the computation mechanism, tell us? The computation mechanism in section 48 told us that from the full value of consideration you will subtract under clause 1 expenditure incurred wholly and exclusively in connection with transfer. Under clause 2 you will subtract cost of acquisition, cost of improvement, and you will also subtract something as clause number 3. Fair enough. Transfer expenses will be subtracted, cost of acquisition will be subtracted, cost of improvement will be subtracted, and clause 3 will be subtracted, and this will be income chargeable under the head capital gains. Fine. So as of now I'll simply write down capital gains. But then we also read the second proviso, and what is the second proviso saying? If long-term capital gain arises from the transfer of a long-term capital asset, then clause number 2, instead of cost of acquisition, you will read it as index cost of acquisition. Instead of cost of improvement, you will read it as index cost of improvement. So the entire formula remains the same. I will start with full value of consideration. Under clause number 1, I will definitely deduct transfer expenses, but clause number 2 will now be index cost of acquisition, index cost of improvement, and there will be no change as far as clause number 3 is concerned, and this will be my long-term capital gain. So guys, now understand one more common sense thing. If the second proviso is talking about a long-term capital asset giving you long-term capital gain, it means that is specifically for long-term, and section 48 ka initial wordings were income chargeable under the head capital gains. So if I take you back to section 48 and if I ask you a question, beta, what do you mean by income chargeable under the head capital gains? What do you mean by income chargeable under the head capital gains? Your answer would be, sir, this can be short term or long term. But now you know that long term is covered by second proviso. So which means this formula that we have seen is for short term capital gain. This is my basic discussion for short term capital gain. Short term capital gain is going to be calculated like this, and if it is long term, so you will be doing index cost of acquisition, index cost of improvement. Now when you read that proviso further, second proviso further, it explains what is index cost of acquisition, what is index cost of improvement. It gives you the definitions. Okay, this I will keep pending because in our lectures, maybe in the 7th or the 8th lecture, we will be doing this indexation aspect in detail. So as of now, I'm not spending much time on it. Now, when we read the second proviso, it said, other than capital gain arising to a non-resident, I am reading these words. Other than capital gain arising to a non-resident, from the transfer of shares in or debentures of an Indian company referred to in the first proviso. Acha, so if first proviso applies, second proviso does not apply. What is second proviso? Indexation. Chalo, let's write down these small but important things. Just 1 second. Cases where indexation is not available, that is, if I write it in technical words, cases where second proviso is not applicable. Okay, first case, so we can easily say कि हाँ भाई, short term capital gain which arises on short term capital assets, but obviously second, wherever the first proviso applies, if the first proviso applies, then even if it is a long term capital asset, indexation will not be allowed. Who is covered in the first proviso? A non-resident is covered. An assessee who is a non-resident. What is a capital asset? Capital asset is shares in or debentures of an Indian company. What is so special about the first proviso? The special thing about the first proviso is that initially for the purchase of these shares or debentures, foreign currency was utilized. So, listen to me carefully. Condition number 1, you must be a non-resident. Condition number 2, shares or debentures of an Indian company are acquired. And condition number 3, they were acquired in foreign currency. So this non-resident is going to be affected, impacted by the foreign currency fluctuations. He has utilized foreign currency for acquiring these shares. That means he brought foreign currency into India. Then it got converted into Indian rupees, and then he used those Indian rupees to acquire the shares or debentures of Indian company. Then later on he sold it. He sold these shares or debentures. So he would have received rupees, but he's a non-resident. He's not worried or he's not concerned about the rupees. What he is concerned with are is the foreign currency, his own currency. So the sale proceeds that he got, he will convert it into foreign exchange and take it back to his country. Now, see this. What just happened? First proviso to section number 48. In this first proviso to section 48, my assessee is a non-resident. He brought foreign currency into India, which got converted into Indian rupees. This was at the time of acquisition. Then at the time of sale, his Indian currency, he got the sale proceeds in Indian currency. This he will convert it back into foreign currency and take it back into his country. But now the exchange rate at the time of acquisition and the exchange rate at the time of sale, obviously there will be a difference. These will be two different exchange rates. So my non-resident is going to suffer or is going to be impacted by this exchange rate, positively or negatively impacted. I'm not worried about that. So suffer would be a wrong word. but I would say this guy, this non-resident, is going to be impacted by the foreign currency fluctuations. He brought the money into India. He brought the foreign currency into India when the exchange rate was, let's say, 62. When he took it back to his country at the time of sale, exchange rate from 62 could have become 72, or 62 could have become 52. So he is suffering from foreign currency fluctuations. Now the first proviso is telling you that capital gains shall be computed by converting the cost of acquisition, expenditure in connection with transfer and full value of consideration. Cost of improvement to hoga nahi. Shares and debentures mein there will be nothing like cost of improvement. So I am only talking about cost of acquisition, full value of consideration and transfer expenses. All these three will be converted by converting them into the same foreign currency which was initially utilized by him at the time of acquisition. So, you know what's happening? What's happening is that the first proviso is asking you to do computation in foreign currency. Your calculations, full value of consideration minus transfer expenses minus cost of acquisition, instead of this being rupees, it will be in the same foreign currency, dollar, pound, euro, dirham, whichever foreign currency you brought into India. Computation will be done in that foreign currency. Now, but obviously it means K, your short-term capital gain or long-term capital gain, depending on the holding period, this is also in foreign currency only, na? So, this short-term capital gain or long-term capital gain which is in foreign currency, this will be reconverted back into Indian currency. Sir, why? Is he going to take back rupees with him? No. This will be reconverted into Indian currency only for the purpose of imposing tax. Short term or long term, whatever it is, it has its own tax rate, na? Tax rate will not be applied on this foreign currency amount. Tax rate will be applied on this amount. Tax rate will be applied, tax will be calculated, collected on the rupee wala amount. So first the conversion will happen in foreign currency. What will now happen is कि my full value of consideration which is in rupee terms will be converted into foreign currency. My transfer expenses, my cost of acquisition will all be converted into foreign currency. Then the foreign currency wala capital gain will be reconverted back into rupees. And that will be only for a limited purpose of applying tax rates. He is going to take back foreign currency only into his country. Ab, thoda common sense use karo. I'll tell you what we were doing. We were studying a situation where indexation does not apply. How do you do indexation? Using your CA inter knowledge, tell me, how do you do indexation? Indexation is done using the concept of cost inflation index. In fact, if you strain your memory a bit, you might also recollect that in this cost inflation index, we used to take base year as 2001-2 and base year ka index number was 100. Our year is 2022-23 where the index number is 331. But what are these? These are index numbers which show the effect of inflation on the cost. I'll repeat this. What is cost inflation index? index number which shows the effect of inflation on the cost. Arey, but which cost? When you are talking about inflation, you are talking about the rupee inflation, na? If a product costed 100 rupees in 2001-2, it will cost me 331 rupees today. But these are in rupee terms. In my first proviso, computation to is done in foreign currency, na? Can you apply those index numbers to the foreign currency amount? Obviously no. And that is why second proviso is saying that indexation will not apply if you are covered by the first proviso. No indexation. In fact, if you now think carefully, I have discussed with you first and the second proviso both. Second proviso is indexation, which will apply for long-term capital gains arising on long-term capital assets. But in the second proviso only, it is written that if you have shares in or debentures of an Indian company acquired by a non-resident referred to in the first proviso, then second proviso will not apply. And first proviso tells you, do your calculation of capital gains in foreign currency, reconvert them into Indian currency only for tax rate purposes. Chalo, coming back to this list, the cases where indexation is not applicable. Third case, see this. Third proviso. Section number 48 has 7 provisos. Second proviso says indexation is to be done. In second proviso, it is mentioned that if first proviso applies, don't do indexation. Now look at the third proviso. Nothing contained in the first and the second provisos. Nothing contained in the first and the second provisos shall apply to the capital gains arising from the transfer of a long-term capital asset, being an equity share in a company, units of equity oriented mutual fund, or units of a business trust as referred to in section 112A. If you remember this from your CA Inter, fantastic. Else, I'll give you a small bit of explanation, very concise explanation. Long-term capital gain is taxed at the rate of 20%, generally speaking. This is section number 112. Long-term capital gains are never taxed by the budget rates. Slab rates, flat rate never apply. Finance Act ka tax rate does not apply only for long term. Long term capital gain ka tax rate is either given by section 112 or given by section number 112A. Generally it is 20%. Now 112A is saying that in this specific situation where you are talking about equity share, units of equity oriented mutual fund, units of business trust, if 112A applies, then the tax rate will be 10%. So common sense hai na? Long term ka general rate is 20%. When I am reducing your rate of tax from 20% to 10%, as talking from the government's perspective, 10% is going to be without the benefit of indexation. We will not give you the benefit of indexation. Second proviso will not apply. Because instead of applying tax at the rate of 20%, I am applying tax at the rate of 10%. So I am reducing the tax rate. Na? So 10% is a tax rate. No indexation will be allowed. First proviso is also not applicable. First proviso means this method of conversion and reconversion. That means number 3, cases where indexation is not available. Long-term capital gain which is covered by section number 112A. Now here I will write down 112A. So what is the tax rate? 10%. By the way, 112A also says 10% cut tax rate after giving an exemption of 1 lakh. That 1 lakh is not relevant today but then it's part of the section, so I'm just writing it. 1 lakh right now is not the point of discussion. I just wanted a student to understand this comparison in his mind कि the general rate is 20%, तो 20 से जब मैं reduce कर रहा हूँ तो मैं indexation benefit नहीं दूंगा. I will withdraw indexation benefit and I will say apply tax at the 10% rate only but without indexation. That means in better words I would say full value of consideration minus transfer expenses minus index cost of acquisition नहीं. I will only subtract cost of acquisition. Second proviso will not apply. अरे section 48 main section तो will apply. Second proviso apply नहीं होगा. And this long-term capital gain, first proviso will not apply. What do I mean by this? कि भाई if the first proviso is not applicable, इक्विटी शेयर तो है ना. फर्स्ट प्रोवाइजो में क्या लिखा था? शेयर्स और डिबेंचर्स. 112A is covering equity shares, so equity shares can be covered by the first proviso. But if 112A applies, तो first proviso will not apply. This method will not apply. ये जो पूरा method है ना, convert into foreign currency, reconvert back into Indian currency, nothing of that will apply. That means in simple wordings, first proviso is not applicable, so your calculation, your computation will be done in Indian currency only. No indexation. Do your calculation directly in rupees. Pay tax at the rate of 10%, that too after an exemption of 1 lakh rupees. So 1 lakh is irrelevant right now, but this is one more situation where even if it is a long-term capital gain, indexation is not applicable. Mera third proviso. See, fourth proviso. Provided also that nothing contained in the second proviso, indexation wala proviso, will not apply if you are talking about a long-term capital gain arising from the transfer of a long-term capital asset. Fair enough. So what's my long-term capital asset? Being a bond or a debenture. Bonds and debentures earn a fixed rate of interest. Company has profits, company has losses, company is bound to give you interest. As compared to that, shares, you don't get a fixed dividend. If you are a preference shareholder, you will get a fixed rate of dividend. Dividend is not fixed or guaranteed. Rate is fixed. Dividend still depends on availability of profits. If the company has profits, preference shares will get a fixed rate of dividend. Equity shares can get any rate of dividend. But dividend payment depends on profits. Debenture holder, bond holder, you are in a secured position, bhai. You will get fixed rate of interest, and that too fixed interest whether company earns profits or losses. So here what is being done is the Income Tax Act is trying to give you a balanced situation. Bonds and debentures, when the bonds and debentures were going on, where the term was going on, the debenture holder, the bond holder earned fixed interest. So when you will sell it, even if long term, indexation benefit will not be given to you. You will only subtract cost. You will not subtract index cost. Shareholder, you did not get the benefit of fixed income during the lifetime of the shares. When you were holding the shares, you maybe got dividend, maybe did not get dividend. Dividend percentage also was probably not fixed for you. So shareholder, when you will sell the shares, you will get the benefit of indexation. Of course, if 112A applies, you don't get that benefit also, but 112A that I'm talking about is a specific situation. I'm currently discussing things very generally. In my mind, I am comparing debentures with shares. Debenture holder, तुमको तो benefit मिलता है fixed income का. So if you have already got the benefit of fixed income during the holding period, you will not get the benefit of indexation at the time of transfer. No indexation. Shareholder, you did not get the benefit of fixed income during the holding period. So now when you will sell the shares, you will be entitled to the benefit of indexation. Indexation claim kar lo, reduce your taxable gain. Bonds and debentures, even if held as long term, indexation benefit will not apply. But there was something else also written there. Just one second. There was something else also written there. Generally speaking, bonds and debentures held as long-term capital asset. See, if they are held as short-term capital asset, so anyways indexation benefit does not apply. If they are held as long-term capital asset, then also indexation benefit will not apply. But let's read this one more time. Nothing contained in the second proviso shall apply to long-term capital gain from long-term capital asset being bond or debenture other than sovereign gold bond issued by the Reserve Bank of India as per sovereign gold bond scheme. Luckily, today only we did a discussion of gold deposit certificate, and if you remember, I said कि भाई we as Indians, we see gold as a place of investment. For us it's not a commodity. Now the problem with that is, if we see gold as an investment, that means as Indians we demand gold, we demand a lot of gold. So India is one of the largest importers of gold, and when we import gold from other countries, we have to pay for that. When we pay for that gold, our foreign exchange reserves will reduce. The foreign exchange reserves that the government has will reduce because it has to pay for that import. Now government came out with a solution to this. What solution? Government said, देखो, we introduce a concept called as sovereign gold bonds. What do you have to do? Don't go to a jeweler and buy gold. Don't purchase gold biscuits, etc. Don't do that. एक काम करो. Come to us. RBI on behalf of central government. Give money. And you give money at the prevailing gold rate. What will RBI do? RBI will give you, RBI will issue this sovereign gold bond. On this sovereign gold bond, you will earn interest also. Very nominal interest, 2%, 2.25%, and like any other normal interest income, this interest income is going to be taxable as income from other sources. But at the end of it, when these sovereign gold bonds will be redeemed, at the time of redemption, you will get money at the time of redemption, you will get money at the prevailing gold rate. We've seen something like this today, nahin? See this. Look at the diagram carefully. In sovereign gold bonds, you are paying money at the prevailing gold rate, and on redemption you are getting money at the prevailing gold rate. Where we earlier saw this was gold deposit certificate, a similar diagram, but there you were surrendering gold, and on redemption you were getting money at the prevailing gold rate. So the event of redemption, it is common. Gold deposit certificate, you get money at prevailing gold rate. Sovereign gold bonds, you get money at prevailing gold rate. But in gold deposit certificates, you are surrendering gold. you are surrendering gold and jewelry in gold deposit certificate. Whereas in sovereign gold bonds, you are paying money. You are not surrendering any gold or jewelry. Gold deposit certificate and sovereign gold bonds are fundamentally different. One more difference which you definitely would have observed. Interest on gold deposit certificate is exempt. Here the interest is taxable. Anyways, interest is not my focus. वो तो interest income है. अपना तो focus capital gains वाले income पे है. So, yes, they are fundamentally two different instruments. Gold deposit certificate is an exception. Gold deposit certificate is an exception. Is this an exception? Nah. So, sovereign gold bonds is definitely definitely a capital asset under section 214. Now, what is the advantage? Government is telling us, okay, see, if you go to a jeweler, you buy gold, you sell gold. You will buy gold at the prevailing gold rate. You will sell gold at the prevailing gold rate. You will earn profit, which will be taxable. Ek kaam kar. Don't go to the jeweler, come to us. You are paying money there also, you pay money here also. Instead of giving you physical gold, we will give you paper gold. Paper gold? Gold bonds. We will issue gold bonds to you. You are paying money at the prevailing gold rate. At the prevailing gold rate, we will give you gold bonds. In case of physical gold, you are not earning any interest income. That physical gold is occupying some place, some space. You are putting it in your bank locker or in your household locker. It's not giving you any recurring income. Gold bonds will give you recurring income also. And at the end of redemption, pretty much similar to sale, you would have sold the gold biscuit at the prevailing gold rate. We will give you the prevailing gold rate at the time of redemption. If people start doing this, it means they will invest into gold bonds. It means they will demand less gold. Lesser gold demanded, lesser gold imported. Our foreign exchange reserves, which were earlier being consumed to pay that gold, to pay for that import of gold, those reserves will now be preserved a little bit. So this is the whole intention of the government. And to make this thing more lucrative, what the government has done is, it has said, okay, on redemption, your capital gains will be exempt under section 47 for an individual. If you are an individual, then under section 47 on redemption, capital gains will be exempted. Now as an individual, I will start thinking, if I purchase gold biscuit and sell gold biscuit, capital gain taxable. But instead, if I purchase sovereign gold bonds and keep it up to the end, so the entire profit is exempt. This is the government's way of tempting the assessee, okay, do not invest into physical gold, invest into gold bonds. Now, this much being clear in your mind, let's play with the exemption wala part. Beta, does everybody get exemption? Nah. Capital gain is exempt only if you are an individual. This benefit is given only for individuals. Sir, that means if the assessee is any assessee other than an individual, company, partnership firm, HUF, तो beta in this case capital gain is taxable. The exemption is allowed only if the assessee is an individual. Acha sir, is exemption allowed every time? Nahi. Exemption is allowed only if the event is redemption. If you keep the gold bonds right up to the end, only then we'll give you the exemption. That means if this individual goes for other methods of transfer, sale, exchange, conversion of this into stock in trade, sir, then there is no exemption. Arey beta, only redemption is exempt na. Only redemption is exempt. So other methods of transfer, even if you are an individual, capital gain is taxable. By this is the only situation where capital gain is exempt. Chalo, with this much clear in your mind, thoda common sense use karo. Beta, if capital gain is exempt, so there is no need of thinking about section 48. What is section 48? Computation. If capital gain is exempt, why should I compute? But if capital gain is taxable, then computation has to be done. Then section 48 applies. And now, if section 48 applies, so all its provisos also apply. And sovereign gold bond at the end of the day is a bond. And we studied just now that if it is a bond, the indexation benefit will not apply. Now, if you say that because it's a bond, no indexation benefit will be given to you, nobody will be ready to buy the sovereign gold bonds, because everybody will say, okay, yaar, if you are not giving me indexation, then what is the incentive? Instead of buying physical gold, you want me to buy these sovereign gold bonds. But if I buy physical gold, then you are giving me indexation for long term. And if I buy gold bond, you are not giving me indexation. So my capital gain will be higher in that case. Government wants sovereign gold bonds to be a substitute to physical gold. So government is saying, okay, if it's a substitute to physical gold, then indexation will be allowed. Don't worry. Like you would have got indexation in case of physical gold, you will get indexation for sovereign gold bonds also. So, cases where indexation is not available, second proviso does not apply. Bonds and debentures held as long term, but in simple words, if this bond is a sovereign gold bond, then indexation is allowed, pretty much like indexation would be allowed for physical gold. So, what is the fourth proviso saying? If it's bond and debenture, no indexation even if held as long term. But if it is sovereign gold bonds, then number one, is it a capital asset? Yes. Number two, do you get any tax benefit for sovereign gold bonds? Yes. On redemption, for an individual assessee, capital gain is exempted. So if you are not an individual, capital gain is taxable. If it is other than redemption wala event, capital gain is taxable even if you are an individual. And the moment you make capital gain taxable, it means indexation benefit will be available to you despite the fact that it is a bond, because this bond is a replacement of physical gold, and therefore you will get the benefit of indexation just like you get the benefit of indexation on physical gold. So first four provisos discussed. Let's go ahead. Rupee denominated bonds. Interesting. Rupee denominated bonds are also called as masala bonds. Government of India gave permission to Indian companies that if they want to raise capital from non-residents, foreigners, they can issue these bonds denominated in rupees. So the non-resident denominated means they are indicated, they are in the face value is in rupees. But if I am a non-resident who is buying these bonds, but obviously it means I will pay foreign currency. Now, general trend was कि भाई as compared to most of the foreign currencies, rupee always depreciates. So when I would have purchased as a non-resident, when I would have purchased this rupee denominated bond, exchange rate was $1.65 at the time of purchase, and I'm assuming US dollar for example. When redemption happens, $1 has become 70, 65 has become 70, so rupee has depreciated, dollar has grown stronger. But there was a time when rupee was gaining, when rupee was appreciating. So I purchased the bond, rupee denominated bond. At that point of time, exchange rate was 65, and at the time of redemption, exchange rate becomes, for example, 59. So now when rupee appreciates, I will earn some profit. See this. See this. There is an Indian company. Mr. Allen is a non-resident. He subscribed to rupee denominated bonds worth $50,000. At that point of time, the exchange rate was $1.70. So he brought in $50,000. So $50,000 into 70, 35 lakhs. This was the cost. Then the rupee denominated bonds are redeemed at par. So Indian company paid 35 lakhs. Indian company will pay in rupee terms. And 70 became 64. So that means rupee appreciated. Rupee became stronger. If fifth proviso was not there, in the absence of fifth proviso, look at the way calculation is done. 35 lakh rupees is what I receive on redemption. At the rate of 64, it becomes $54,687.50. When I brought this money into India, I brought $50,000, which was converted at the exchange rate of 70. So 70 was at the time of acquisition, 64 is at the time of redemption, $4,687.5. This is the capital gain. And if you understand, this capital gain is arising due to appreciation of rupee, due to 70 becoming 64. Now income tax officers, assessing officers started telling these non-residents, chalo, this is taxable capital gain, pay tax. If you carefully think about it, he's not earned any profit technically. 35 lakhs ka bond is redeemed for 35 lakh rupees only. This 4687.5 is his capital gain profit because of rupee appreciating. And actually there is no profit. This profit is arising due to foreign currency fluctuations. And for India, non-resident investment is important. So, due to the fifth proviso, what will happen? My full value of consideration shall not include this 4687. 4687.5 is due to rupee appreciation, 70 becoming 64. FVC may say, we will remove this 4687. Obviously, it meant that taxable capital gain became 0. Now, if, for example, this is my first example, okay, any capital gain due to rupee appreciation, any capital gain due to rupee appreciation will not be taken into account, will not be considered, will be ignored for FVC calculation, full value of consideration. Example 2. Suppose the bonds were redeemed at a premium of 7%. Up 7% का premium है, company has paid 7% extra. So, but obviously this तो should be taxable ना. Surely, definitely this should be taxable. But at the same time, 70 का exchange rate became 64 also. So, 35 lakhs का face value plus 7% का appreciation in the form of premium, 37,45,000 is the rupee amount that the non-resident would get on redemption. Convert that into 64 का exchange rate, less 4687. This is the gain due to rupee appreciation. This will not be taken into account for full value of consideration. Isko hata do, isko nikal do, remove it. Balance what remains is the FVC, which includes the premium component redeemed at a premium. So it is only $3828.13, which at the rate of 64 will be converted. 64 is the exchange rate at the time of transfer. So we are taking that 64 ka rate, 2,45,000. And if you carefully observe, 2,45,000 is the exact difference between 37,45,000 and 35 lakhs, the 7% premium. So it is only that 7% wala premium which is becoming taxed. It is not the rupee appreciation wala gain. Third example, if rupee had depreciated. अब अपना common sense use करो बेटा. If rupee appreciates, so there is a gain for the non-resident at the time of redemption. That means if rupee depreciates, there is a loss for that non-resident at the time of redemption. Now this proviso is only talking about appreciation wala situation. This proviso is only saying कि भाई any gain arising on account of appreciation of rupee, if the rupee depreciates, then this fifth proviso is not applicable only. No problem. If that fifth proviso is not applicable, do your calculation in the normal way. That means if, for example, 70 became 74, rupee depreciated, to calculation karo, it will result into a loss. This 2 lakh rupees ka capital loss will be allowed for set off and carry forward. You can see how, I won't say prejudiced, but I would say you can see how favorable treatment is given to non-resident. If rupee depreciates, there will be a capital loss calculated. We will allow him to set off carry forward that loss. Set off and carry forward will be permitted, will be allowed. If rupee appreciates, then that profit will not be taxed. If rupee depreciates, then the loss can be set off and carry forward. If the rupee appreciates and you have a premium on redemption, only the premium component will be taxed. So we have created a provision which is tilted towards the non-resident. It is for the benefit of non-resident, and the reason is also pretty obvious na, कि भाई we are giving benefit to the non-resident. You invest into our Indian company by buying these bonds, we will get foreign exchange inflow into the country. Now at the time of redemption, if rupee depreciated, non-resident, you will have a loss calculated. Take that loss calculation, set off karo, carry forward karo, permitted. If rupee appreciated, don't worry, on that appreciation, whatever gain you had, we will not tax that gain. We will remove that amount from the full value of consideration only. Chalo, last two provisos remaining. Now, sixth proviso is something that we will do tomorrow, because sixth proviso is connected to 47.3. So once we study 47.3, we will come to sixth proviso also. I am just keeping it pending for one lecture. Tomorrow's lecture we will see, in our third lecture we will see what this is. Seventh proviso, seventh and the last one, no deduction of securities transaction tax. Very simple yet very interesting. No deduction of securities transaction tax. See, heading is not that important. I want you to read this. No deduction, provided also that no deduction shall be allowed in computing the income chargeable under the head capital gains in respect of any sum paid on account of securities transaction tax under chapter 7 of finance number 2 at 2004. In the 2004 budget, STT was introduced, and 2004 was the year of elections. So in an election year, there will always be two budgets. Now I don't know if you know this. the ruling party before the election in the month of February will come out with a budget. They will call that as the Finance Act, whichever year it is. 2004 was the year in which elections happened and Congress won. From 2004 to 2014, for 10 years, Dr. Manmohan Singh was our Prime Minister. Then Finance Act 2014. 2014 election happened. That is when Mr. Narendra Modi became the Prime Minister for the first time. So if you will observe this, in 2004 there were two budgets. One was prior to the election. The ruling party before the election comes out with a budget. Generally they don't make many changes in that pre-election budget. After election happens, whichever party comes to power, they come up with a second budget. That is where the major amendments and changes are. So the second budget is called as Finance Number 2 Act. This Finance Number 2 Act. If you Google this, you will find out in 2014 you had two budgets. Finance Act 2014, Finance Number 2 Act 2014. The second budget, number 2 wala, that was presented by, who was the finance minister at that point of time? I think Mr. Arun Jaitley. Finance Number 2 Act 2014. Yeah, if I remember correctly, it was probably Mr. Arun Jaitley. So, in the year 2004, after the elections, the second budget that was announced introduced the concept of STT, Securities Transaction Tax. And Section 48 ka proviso is saying no deduction shall be allowed in computing capital gains of any sum paid on account of STT. Now pay attention carefully. No deduction shall be allowed of STT. Let me write something relating to STT. Where do I have some space? Do I have it? Yeah, chalo, fine. STT, Securities Transaction Tax, is paid by the seller, but at the same time beta, it is also paid by the purchaser. So seller will pay it on sale, purchaser will pay it when he purchases. This STT is paid to that recognized stock exchange, Bombay Stock Exchange, National Stock Exchange. You are using their system of trading, you are using their mechanism of trading. So as charges, you are paying STT to them. Now read the proviso for the last time. No deduction shall be allowed. Does it say to the seller? Nah. In computing capital gains, no deduction shall be allowed of STT. So, see this. Mr. Ronak sold 2000 shares of HDFC Bank Limited at 167.90 per share to Mr. Nihal through National Stock Exchange. So in this case, who is Ronak? Ronak is the seller. And who is Nihal? Nihal is the purchaser. Both Mr. Ronak and Mr. Nihal paid STT of 0.1%. So for me it's an expense, yes. But the STT that I have paid will not be reduced from the full value of consideration. So seller, you cannot subtract this as transfer expense. Now who is Mr. Nihal? Nihal is the buyer. For him, STT is paid on purchasing the share. It's a cost. It's a cost in connection with acquiring the shares. If Mr. Nihal, in the calculation of this cost, adds the STT, then later on, when Nihal will sell it to one Mr. X third party, he will subtract this cost of acquisition, which includes the STT component. So indirectly, Nihal in a future transaction will get a deduction of STT. And what is the proviso saying? Proviso is very clear. No deduction shall be allowed in computing the income chargeable under the head capital gains. No deduction shall be allowed. Kisko? To the seller also and to the buyer also. So seller, you cannot reduce it as transfer expenses. Buyer, you cannot include it as cost of acquisition. Chalo, summarizing, if you remember, our base was our charging section 45 subsection 1. Capital asset, we saw the definition, 4 exceptions, securities by FII, unit linked insurance policy, short term long term ka distinction, 12 months, 24 months, 36 months, transfer, sale, exchange, relinquishment, conversion of capital asset into stock in trade, compulsory acquisition, zero coupon bond, matured, redeemed, 53A of Transfer of Property Act, transfer ka definition, gain or loss computation, from full value of consideration, transfer expenses, clause 1, cost of acquisition, cost of improvement, clause 2, 48, clause 3 pending, we will discuss it much later. Second proviso says indexation will be allowed for long term. If you are covered by the first proviso, non-resident, investing foreign currency in shares and debentures, second proviso, indexation will not apply. If you are covered by long-term capital gain as per 112A, so third proviso is telling you that indexation will not apply, and first proviso ka conversion reconversion method will also not apply. Fourth proviso is telling you bonds and debentures held as long term, no indexation, but sovereign gold bonds indexation will be available. Fifth proviso, rupee denominated bonds getting redeemed and rupee has appreciated, so that appreciation component will not be included as full value of consideration. Sixth proviso I have kept pending. Seventh proviso, STT, seller cannot deduct it as transfer expense, buyer cannot capitalize it into cost of acquisition. Chalo, with this my 45.1 gets over. Now I will take the chapter ahead. In my tomorrow's lecture we will discuss the further sections. We've done 45.1, we've done various other sections. Now how to study this chapter, how to take it forward, in what sequence should you study. There are so many sections, na? In what sequence will you study the chapter? That's how I will begin our tomorrow session. Chalo, I'll see you in the next one. See you, tata, bye bye. And if you have liked this, please put up a thumbs up, like, share, subscribe to the channel, share it with your friends. See you, bye bye.